All right, this is this week's episode of the CIO Brief. I am Brad Johnson with Evergreen Capital. We have our associate Jesse with us again this week. Hi, Jesse. How are you doing?
Good. Doing well today.
Are you ready for the weekend?
Yeah. Got plans to go fishing tonight. Gonna catch some bat rays out here in Newport Beach, so we'll see how that goes.
At Rays. Okay. Now, are these the ones with the stingers on the end that Joey had to help Ross in Friends with his stinger on the beach, where it was very painful and he had to do something kind of gross to help his buddy out?
I'm gonna act like I have seen that episode. I'll just say
Okay.
yeah. But yeah,
Okay.
these ones they can get as big as people, so they're pretty big.
Wow. And what do you catch them with?
Just a regular deep sea rod and a bait caster.
Well,
Reel.
what
Yeah.
kind of food though? It's like just what kind of bait?
Yeah. They like squid. Most of these creatures out here in Newport like squid, but yeah, I put a big, 2, 3 inch chunk on it, and you got a bat ray when you hear your reel, it just starts screaming. Just
Okay. Well, we're learning a lot about Jesse today. Okay. Well, good. Well, good. That wasn't gross at all. No, no, that's exciting for the kids, I'm sure. Okay, so let's get started. I usually like to start these out with a lesson that I want to leave to my kids that really acts as both an investing lesson and a life lesson. And today's it has to do with longevity. We've named the firm Evergreen. We're very focused on longevity, things that we can stick with. And so the quote is, choose your path that you're willing to walk long after others have quit. Another twist on that is find the work that you can endure longer than anyone and do it relentlessly. And I think that people underestimate the power of sticking with something just an unreasonable amount of time. And that is especially true with investing. If you stick with your strategies, you stay invested for the long term, you're going to get those compounding returns. You're going to grow your wealth larger than you can even imagine today. And so the key is investing in things that you have confidence in, diversifying so you can stick with them and not bail out when you have some volatility. And I think that applies to a lot of lessons in life as well. All right. So let's jump into the first investment spotlight here. The investment is commercial real estate debt. And that is pretty simply loans that people are making to commercial real estate projects. Think about it as your mortgage. If you have a mortgage on your house, it's the same concept. So you are the bank, but instead of lending to a homeowner, you are lending to a commercial real estate investor on their investment property, whether that be an apartment building, maybe it's a warehouse, maybe it's a hotel, maybe it's, God forbid, an office building, which has obviously been challenged the last 5 years post-COVID, but it is having a bit of a resurgence as people are heading back to the office. But commercial real estate historically has been kind of a sleepier type of investment, especially when interest rates were so low. When interest rates are zero, it's hard to get a meaningful return on a loan that you're making on commercial real estate property. Oftentimes the returns were maybe 5-6%. But now we're seeing plenty of opportunities in the 8 to even 12 range because you are having a lot of properties that need a little bit of extra leverage to try to fix them. They're making these loans, these investors are making loans at really attractive pricing. And so if you think about the margin of error you have versus 2020, you have a much wider margin of error today making a loan to commercial property because the valuation has declined. And so your loan to value, that is the loan relative to the purchase price, right? It feels a lot safer today, and yet you're getting a higher return than you have over the last 5 years, really the last 20 years in commercial debt. So it's a safer investment. Debt is always going to be a safer investment than equity in the same industry, right? The equity sits above in the first loss position if something goes wrong and the borrower can't pay the lender, the bottom stack. The lender takes the property and can resell the asset and recoup their loan, and oftentimes a lot more than their loan balance. So that tends to be, once again, a safer investment. And if you can get a 9% yield, 8, 10 on some riskier debt investments where you're kind of going higher in leverage, but you feel like the return is worth that extra risk. We see a lot of that today. Either way, you're getting a lot more return versus your historical risk. So we like that combination, higher returns, lower risk. And so commercial real estate debt is pretty compelling today. And so we are starting to make investments in that space. And I think we will for the foreseeable future, given that I don't think interest rates are going back down to zero. It's really hard for me to see how the country can have $27 trillion of debt and keep selling our treasuries at 0, 1%, 2% type of rates. People are demanding higher interest rates because the debt is a little bit more risky given our balance sheet than what it used to be. So, with higher interest rates than historically has been the case, that means that commercial real estate is probably going to be a pretty good returning asset for the foreseeable future. And once again, a lower risk type of investment where you just get that monthly coupon payment, just like you were a bank. We love we love adding that type of risk return to our total portfolio because it increases cash flow and it lowers the volatility, which is a great combo. All right, did that make any sense, Jesse?
Yep.
Okay, good.
Loud and clear.
I'm not talking crazy on Friday afternoon, even though it's been a long week. All right, so that was a spotlight for commercial real estate debt. Now let's talk about some client insights that we had this week. A conversation I actually had today with somebody I've known for a bit who has invested with us and had an issue unrelated to our investment. He is looking at purchasing his commercial real estate property that a business that he owns is one of the tenants. And so this would be a typical investment for maybe a manufacturing firm or a lower profit type of business that wants to control their real estate, right? They want to control their destiny. They don't want to be beholden to a landlord who can say, hey, well, your lease is up and we're not going to renew your lease. We're going to sell the asset, the building, and you're going to have to go find some other location. And if you can imagine, if you have a lot of heavy machinery or that asset, it has a lot of equipment, it's not super easy to move down the street or across town to a new location. And that's a real bummer. It sets your business back because you're spending all this time, looking for a new location, you're moving, whereas you just want to be focusing on making money and servicing your customers. But it doesn't necessarily mean that buying the property is a great investment. It depends on the terms, like anything else. And so this client in particular was kind of looking at the underwriting of the asset as if he was almost like getting a type of bond debt return, kind of in the 8% range. And that's if everything went well. There was no big capital surprises like the roof having issues or property taxes being a little bit off of his underwriting or electricity costs spiking, right? So there was a lot of, I would say, not aggressive, but maybe just hopeful assumptions in the underwriting. And the business had a 15-year lease left, right? The business could stay in that property for 15 more years. So it wasn't obvious to me that he necessarily needed to buy the asset to control his destiny. But anyways, we'll see what he does. We actually advised him not to do it because you have to kind of think about it. Okay, if I have $1 million today and I have the entire world to choose from an investment standpoint, is this the investment that is the best home for this incremental $1 million? 8% return in equity, when we just talked about commercial real estate debt at 9, sometimes 10%, much less risky asset, completely diversified over hundreds of loans. That feels a lot better than a maybe 8% return at 85% leverage was the loan he was talking about. And the bank wanted him to sign personally for the loan. And so he's putting a lot of his net worth, millions of dollars of his net worth at risk if the underwriting, the business doesn't work out. So anyways, I don't think it was the greatest idea to move forward. We'll see what the firm does, but it's a good way to think about your options. So sometimes people kind of get tunnel vision on, we're a manufacturing company that owns this building. We're supposed to own the business. Well, yeah, but maybe you need to kind of step back and look at the universe of possible investments and not just go into a piece of property just because that's quote what you're supposed to do. You have to isolate it from the business and look at it as an investment on its own merits. But have you heard about this dynamic of smaller businesses buying their own real estate, Jesse?
Yeah. I was just hearing a little bit about it earlier today.
Go figure.
Yeah, but it. I think I understand why we advised him otherwise to not purchase the building in the short
Yeah.
term.
It's interesting because, a lot of, if you just think about the quality is of maybe a manufacturing business, they tend to be lower margin businesses. Some of them, sure, generate a crazy amount of profit for their owners and do quite well. But the majority of them are pretty thin on profits. And so what you see this actually a lot in that the business over 20 years tends to not generate a ton of excess cash flow. But if they do buy the building, so this is advice, contrary to the advice that I gave our client today, but you see these businesses that do buy the building and they can barely afford to pay the rent and all the employees. So it's a little stressful, but they make it through. And then 20 years later, the business is not worth very much, but they have this asset free and clear. So that is the flip side. That is the dream. If you can get the right turns on the asset, you're the tenant if you own the business. And so you can control the terms of the lease. You can actually maybe have a slightly higher lease rate, which would reduce the taxes of the business. So it's almost like you're kind of optimizing your balance sheet of both investments. But it's a unique way for smaller businesses in America to gain equity to, if maybe their main business isn't super profitable, as we discussed.
So you advise the client to not go through with the purchase of the building. Do you know what they're going to do with the money that they're looking to invest?
Well, yeah, that's the interesting thing is that they kind of pass the owners of this business pass the hat around into both the partners and some of the key employees. So it's a meaningful amount of money for some of these investors, right? I I don't know what they're going to do if they choose not to buy the building, but there's obviously endless amount of investments they could make. If I was their advisor, I would be pointing them towards some of the offerings that we talk about because we believe in them, right? As for example, commercial real estate debt, GP stakes, which we've talked about in the past, if they qualify for that, is certainly what I would recommend. Certain real estate properties, like multifamily, affordable housing type of assets that are offering a ton of tax benefits right now, are very compelling. The stock market we talked about last week is a little elevated in terms of the current valuation, but you always want to be adding savings into the market more methodically, I think, unless you already have a full position. We kind of talked about sizing your position last week relative to valuations. So there's a lot of places that they could put their money. I just think this one they were taking a lot of excess risk relative to the upside.
Got it.
All right. So next segment is signal versus noise. We get a lot of news every day. We get bombarded with these headlines, and especially in the financial market, it's difficult to know, okay, which of these headlines and news reports should we be listening to, and what can we ignore? And we don't have all the answers, of course, but this is our thought in terms of today's headlines, what we're out today and this week, what was interesting. But the question is, was it signal or was it noise? And so today, the induction of Robinhood, the investment app on your phone, into the S&P 500, I thought was pretty interesting news, because I think of Robinhood as kind of the small consumer app that millennials like to play with to buy options, but it is a real business. I didn't realize that it had 15 million customers and was doing a ton of revenue in brokerage fees, and especially with cryptocurrency, and has now gotten into a bit of gambling, which I do not like. I personally think I have a love-hate relationship with this headline. I think there's a lot of good things with Robinhood in terms of educating a younger investor base on the merits of investing, getting them kind of to understand what investing is. And frankly, even if they do lose their shirt, which I have to think a lot of them are if they're trading options every day, especially the zero date option, which expire in one day, is an insane investment product that obviously we don't encourage people to pursue. But if they lose a little bit of money, you feel that lesson. It's one thing for us here talking about it. It's one thing to hear a lecture. It's quite another thing when you actually lose money. You internalize that lesson. You internalize that experience because, wow, that stings a little. I lost a fair amount of money that I worked hard for on this short-term crazy investment that I made versus methodically buying into the stock market and getting equity over time, and then adding other assets like private equity, commercial real estate debt, venture capital, real estate. So I'll stop there. Like Robinhood? What do you think about Robinhood? And do you like the concept of being able to just quickly trade stocks and zero date options on your phone?
Yeah, so personally, I prefer to put in a little bit of money at a time and do it, like you said, methodically. Over time, watch my money grow. So I'm not much of a short term investor myself, but I do know people that figured out how to be successful and make some good money doing it. Should less educated, less skilled people be doing this? I would say to me, it doesn't seem like a smart option, especially if you don't have a lot of extra money to be thrown around.
Yeah.
But I prefer more of what we teach here at Evergreen Capital.
Well said. I mean, you were uncoached, and he came up with that, folks. That's amazing. But yeah, I think that's right. I think most people would agree with that. Okay, so I think that's the downside of Robinhood is that it is kind of encouraging a more faster paced style of investing. The good side is that it is bringing more people into under the tent, so to speak, in terms of the ability to invest and the lessons learned that ultimately when they are 40, 50, 60, when the stakes are so much higher, they have a lot more money to lose if they do something silly. I think that's a good thing because the stakes are fairly low when somebody's frankly your age and is trading options. They're not going to lose $10 million trading options. Certainly they could, right? If they became very wealthy and started playing around with zero day options when they were 50. Anyways, once again, love hate. I think this is actually a little bit of signal versus just noise because I think that there's a bit of a movement towards cryptocurrency with your generation. There's a bit of a movement towards excellent user experience, modern technology versus calling up your stockbroker, trading on E-Trade or Charles Schwab, which are fine companies, but they don't have slick UX, right? Where you're just like, oh, boom, bought, sold. It feels almost gamified. It feels like a video game, in other words, right? When you're trading these stocks, when you're making these investments, when you're buying Bitcoin and you're seeing the volatility go all over the place. So I think this is a bit of a trend in terms of where future investors will be. They're not going to be trading zero dated options when they're 50. Hopefully those lessons will be learned. You touch the hot stove, you get burned. Hopefully people will get that lesson and internalize it. But I think they will continue to want more modern technology in their investment options, in the platform that they use. That's why we tend to prioritize very interesting modern technology with our investment platforms, with our portals, investor portals, because we just feel like that's where the puck's going, right? You can kind of get away today with something that looks like DOS, that is an investor portal. You can get away with having people fill out paperwork by hand and even fax it in if you wanted to. But that's not where we're going to be in 20 years. And so we don't want to be focused on that today. We want to be thinking ahead. And so I think that this Robinhood joining the S&P, and coincidentally, when Caesars is exiting S&P today, so Robinhood in, Caesars out today, which is kind of funny. It's like the new guard versus the old guard leaving. But I think that is a bit of a signal in terms of where the investment universe is going and where the marketplace is going. With that, I think we'll go ahead and go to the question section of our show here, and then we'll wrap up. Jesse, are there any questions submitted?
Yeah, we got some questions today. So just before I get into them, Brad, I don't know if you've ever had the opportunity to give a candid introduction to yourself. So I thought it would be a good idea if
Gosh,
I already know Brad doesn't like to talk about himself very much,
I like
but
to talk about the clients. I like to talk about
yeah.
the employees. I'd like to talk about everybody else but me.
But today, our investors, our clients, and people on the internet, they want to know a little bit about you. They want to know some of your background. What's helped you to be successful and what along your journey has helped you out the most to get you to the point where you are today. So I've got just a few questions I want to ask you to give you that opportunity to let our listeners know you on a little bit of a more human level. So
Oh,
first question, Brad, just give us the basics. Where were you born? Where do you come from?
we're going
And
we're going deep.
yeah, we're
Oh,
going early on. So where were you up through your college years? Yeah, just give me a little history up until about my age, Brad Johnson style.
okay. Now, Jesse, this is called the CIO brief. We're supposed to be brief.
We're going back though.
Okay. So real quick, grew up in Laverne, California. So the office is in Newport Beach today. Laverne is 45 minutes away. Grew up the son of a paper salesman who is the best dad in the world. Still to this day, we golf once a month, and it's some of the best time I spend all year. Is that time with dad every month. Went to Cal Poly San Luis Obispo, studied business there, came out right around the crash of the internet. It was tough to get a job, took a sales job, which I thought was, I wanted to follow my father's footsteps at the time. I didn't really know exactly what that career was going to look like, but so glad that I did it because I had to go really business to business and try to pitch them on DHL, which is the shipping company, pitch them on their services. And I got to meet all these business owners, all these random entrepreneurs in these industrial parks, not unlike the building that we're talking about today. Just kind of walk in cold and introduce myself and try to sell my wares, right? Which is hard. It's really hard, especially as a 23-year-old. But you got to learn all these businesses and see, oh, wait, that's a really good business. These are horrible business. These don't make any money. And so I kind of fell in love with that. I kind of fell in love with business. I kind of fell in love with the concept of being an entrepreneur. And I got better at sales. I don't think it's my number one talent, but it's such an important life lesson and skill set to be able to just talk to people and present your ideas, present your products, of course. And so it's almost like a foundational skill that you need in your career. And I'm really grateful for it. And that led to me starting a business with some buddies in our 20s that was focused on that industry, consulting to those businesses, helping them get lower shipping rates. It was kind of a messed up thing that I was lowering my former employer's profits in that regard, but it was a great business. We would take 10% of what we saved, the clients usually. So they weren't coming out with any new cash. We were saving them money. So it was a good business model, not an amazing one, but a good one. And then, sold that business to my partners so I could pursue commercial real estate. And that's when I started investing in real estate because I kind of just fell in love with it, doing it on the side with our profits, buying just single family home rentals. My last one that I own, I'm selling next year. It's been an interesting process. There's a lot of great things about it, a lot of challenging things about being a landlord, of course. But so got into real estate and really just kind of stuck at it for an unreasonable amount of time, which is the lesson of today is that if you focus on something in an industry, a skill set, and you really apply yourself, you just almost have to get better at it. And your knowledge compounds, your relationships compound, and then the money kind of follows suit with those two things. The money doesn't come first. It comes after you get good at those things and after you've really stuck with it for longer than most people do. I'll stop there. That was just kind of an intro to my younger years. But I think you happen to bring it home and tie a bow on the whole episode here with kind of sticking with things for a long time. And then you get to benefit from the fruits of that labor and that determination. Was that what you were looking for? Was that good enough for today?
Hey, that was good. I mean, I know this is called a CIO brief, but I have many more questions to ask you.
All right, well let's go back to investing now.
Okay, yeah, let's do that. So, we were just touching back on your younger years. I assume your take on investing has changed a lot over the years. You've been in this industry for how many years? How many years have you been in the investing
You're
world?
really dating me here.
Like
20?
100 some
Yeah,
Oh,
I got
20.
like 100, yeah.
20. Okay. So, what has changed in the investing world and especially as far as your investment philosophy goes, what has changed and improved in the last 20 years?
Quality in terms of the asset, in terms of the business. In the beginning, I kind of just focused on total return. So if something in Excel said it was a 20, 30% IRR, that was interesting to me. That's a high return. But oftentimes, those are discounts you're getting for a reason. There's some distress. There's some hair on the asset. It's not to say that you don't find these opportunities today. It's much harder in the public market than it was 20 years ago, 10 years ago. Of course, things have gotten very efficient, which is why we don't put a lot of client capital into specific stocks. It's fine if they want to dabble. I love to dabble with a handful of stocks in my equity portfolio, but the majority of it, we recommend clients have in ETF or in a pool of stocks that replicates the entire market. So you're getting a market return for that chunk. and then you can dabble, have fun with some side investments. That's changed. And so I think quality is incredibly important because once again, it goes back to just staying power. If you can hold an asset that generates high return on equity, in other words, just a lot of profit, it's a great business. You want to ride that business because they tend to start getting better and better with age. It's almost counterintuitive. You would think that, economic theory would suggest that, okay, the advantages would bleed away and these businesses would have, new entrants would come in and would start eating away at those margins. But we see time and time again, great businesses and great assets, whether that be, an amazing business in the S&P 500 and the Mag 7, or it's a wonderful piece of real estate. Those advantages tend to compound. A prime asset, a prime piece of property on the corner of Main and Main is going to retain its value for a very long time. Even during COVID, you saw this with office buildings, like the best, highest quality assets. And I'm not suggesting our investors go buy office buildings, but the best assets retain their value and actually held up on lease rates. Whereas the Class C, kind of rough on the edge of the market assets just tanked, just plummeted. And it's sad because a lot of people lost a lot of money. If you had just kind of paid up just a little bit, maybe it feels almost a little bit uncomfortable to sometimes pay for the best in a certain segment. Oftentimes you just see those assets continuing to win and keeping that advantage over time that ends up compounding capital at a great rate for an unreasonable amount of time, which is how you get insane multiples on your investment over 30 years, is from staying in the market, staying in a great asset versus, trading in and out, trying to get those 20 IRRs, but you end up sitting out of the market for a year because you're looking for the next great investment that, may or may not be a 20. Oftentimes it's a 0, right? Every once in a while, that distressed asset is distressed for a reason and it tanks. But a great asset, I kind of think of, the stories of like a Chipotle having a news crisis where their food got some people sick. Horrible, but it was a fixable, solvable problem and a great company, a good business product. So the stock tanked and the people that believed in the asset could buy it for a reasonable multiple at that time and hold it for a very long time, have done quite well. I'm not saying go buy a restaurant stock. Usually those are tough businesses, but that's an example of occasionally you get these opportunities with an individual investment. Occasionally you get them with real estate properties when the market kind of gets anti-real estate like it did a couple years ago. Right now is kind of a good time to buy real estate. It's a more challenging time because interest rates are still high. But the quality assets at a reasonable price tend to deliver long-term returns that are higher than you might expect. Anyways, that's a long-winded way of saying I think focusing on quality is the major lesson in the last 20 years.
All right. Thank you. Should we wrap things up for today?
Yeah. Yeah. All right. Thanks everybody for listening in. We'll be back next week with another the CIO brief, and have a great weekend, and we'll talk to you soon.
Thank you.
Thanks,
Bye.
Jesse.